Australia's never-ending property bubble. Let's have a look. Hello everyone, Florian Heise here, and welcome to another episode of HeiseSays. I thought we'd have a look at this article from the ABC about really our property bubble that we have here in Australia and how the former RBA boss, Ian Macfarlane, can't see a crash coming. So we can't see a crash coming. Before we go through this, guys, let me know what you think. Do you think there will be a property crash? Are you hoping for a property crash? I mean, I'd argue that foreign investment really pushed up that bubble. 14, 15, moving on. It just went nuts. It went nuts. But our cash rate is insanely low. And if they keep just pumping out the money, what will make it pop? What will make it pop? I mean, this is the thing. People always say they can't see a crash coming. A lot of people, most people, didn't see the GFC crash coming. How many people said they can never see a crash happening in Ireland? So maybe this is another warning sign. I guess the RBA are just so fantastic at their predictive models that we should be taking the opposite view from this. Or will it be not an actual monetary crash, but a devaluation of the purchasing power of our money to such a great extent that we'll have a serial crash in reality? So let's have a look. So, hindsight is 20/20, so they say. But some big calls do seem to stand the test of time. One of those is the Reserve Bank's decision to start rising interest rates in May 2002, having cut them only 5 months previously. In his statement explaining that rate cut, then RBA Governor Ian Macfarlane had expected the global downturn following the dot-com bust to worsen and Australia to feel the fallout. The dampening impact on other parts of the economy of global events will become increasingly clear during 2002, at a time when the housing upswing will begin to moderate, it predicted. But that didn't happen. In fact, the US economy posted strong growth in early 2002, and the rest of the world was being dragged along with it. Moreover, the moderation in house prices that Mr. Macfarlane forecast didn't eventuate. Well, there you go, an RBA forecast that didn't eventuate. I'm not even surprised anymore. By May 2002, Mr. Macfarlane seemed to be following the famous adage generally attributed to economist John Maynard Keynes, "When the facts change, I change my mind. What do you do, sir?" Well, I guess Keynesian economists are always very good at having to change their minds. That just shows me that there's some fundamental issues with their methodology. And it's like a dark art, isn't it? More art than science. The strong rises in house prices seen over recent years have also been associated with a rapid expansion in household debt, a process that carries long-term risks if households become seriously overextended, he wrote then, justifying the rapid about-face on rates. And with what we're starting to see arrears rates recently increase, but I'm hoping the cash cut has eased off on that for a lot of people. I mean, it's all play money, isn't it? It's all pretend. So they can manipulate it, and they get these manipulations in the market, and then we get these bubbles. To persist with a strong expansionary policy setting would risk amplifying inflation pressures, and over time could fuel other imbalances such as the current overheating in the housing market, potentially jeopardizing the economy's continued expansion. So the Reserve Bank tapped the brakes on housing bubble 1. Looking back on the data in a recent interview with Josh Walker for his Jolly Swagman podcast, Mr. Macfarlane said he was very happy with the results. I don't know whether we did it, but certainly house prices stopped rising. Certainly, that's what we were trying to achieve, and it was a gentle landing. They didn't collapse, he said. Gentle is something of an understatement. On average, house prices kept rising for another 2 years and then remained broadly steady for a few years until the rate cuts and first home buyers boost in the wake of the 2008 GFC stoked them again. So, is this just someone claiming claiming credit for something that they, he doesn't even know what they did. I mean, the market just responds. But for Hearst home buyers, the damage had already been done. During McFarlane's tenure as central bank boss, average capital city house prices rose 120% and went from being just above 4 times annual income to nearly 7. Now, we can see that in this chart here. I mean, there you go. There's the housing affordability, the dwelling price to income ratio. Is that a sign of success? Is that a sign of success, or is that a measure of failure? Depends on who you look at it, which angle you take. So house price change during Ian McFarlane's RBA tenure. I mean, there you go. Is this percentage? Oh, indice starts at 0. Oh, bugger. There you go. In September 96. The ABS changed methodology and continued this series in June 2005. I mean, there you go. Look at that. Look at that increase in that index. In Melbourne. Look at Melbourne. Look at Sydney. Where's Brisbane? We're the poo brown colour. We're there. There you go. We're just on average. Brisbane is just on average. Mr. McFarlane argues part of this surge was the inevitable consequence of taming inflation. We finally got inflation down and were able to bring interest rates down, and when interest rates came down, people could afford to service bigger mortgages, he explained. Bigger mortgages, of course, mean people have more money to spend on houses, pushing up prices. So capital gains tax cuts sparked crazy property speculation. But that had already happened in the 1990s. So what explained the pop in housing prices at the turn of the millennium? On top of that, we had something that was really harmful, which was pure speculative activity, particularly through negative geared acquisition of second, third, fourth, and fifth properties, Mr. McFarlane continued. I'm particularly talking about a period around the turn of the century from 2000, particularly 2002 to 2003, when it was at its peak. It was starting to get pretty crazy then, and it was starting to get pretty close to a bubble. The interview doesn't really dive into it, but there's only one major policy shift that could have triggered such a stampede into speculative property investment, and that is the Howard Costello government's decision in 1999 to effectively halve capital gains tax overnight. Albeit probably exacerbated by its goods and services tax, which pushed up the cost of building new homes relative to buying existing properties. So those two things combined. And all of this is different forms of intervention in the market, guys. Manipulating the market with intended and unintended consequences. This 50% capital gains tax discount gave higher earners a strong incentive to convert current income from salaries, profits, and investments into future capital gains that would be much more lightly taxed. The obvious way to do this was through borrowing money to build an investment property, deducting the interest bill against your current earnings, and if the property prices kept going up, pocketing the profits from selling while only paying tax on half of them. To give a sense of the change in the property market after the capital gains tax discount, the number of taxpayers reporting a rental loss jumped from 631,435 in 99-2000 to more than 1 million in 2005-2006, while the number of landlords reporting a profit actually fell from 532,000 to less than 500,000. So there you go. I mean, there you go. There's why. And the problem with this is, guys, this is creating an incentive for people to invest in the property sector, and it means that we're not getting investment in other parts of the economy. This is why we're turning into a primitive banana republic where we dig stuff out of the ground, ship it overseas, build houses. 57% of our wealth is in houses. How many funds? I think I was reading today about a business. How many businesses, primarily Australian innovative businesses, list overseas to raise their capital? How many people have you heard about it heading over to Silicon Valley to get funding for their startup here from Australia? We don't really have that culture here. Everyone's just buying houses and flipping them. So effectively, this meant Howard and Costello left Mr. McFarlane's Reserve Bank to clean up the mess it made of the property market with only the tools the RBA has, the blunt one of interest rate rises. Luckily, America's rapid recovery from the dot-com bust and China's epic growth in the early 2000s with the Australian mining boom that triggered meant the RBA could do this and check further property price gains without sinking the broader economy. So the Reserve Bank generated property bubble number 2. The next property price boom was sparked by dramatic interest rate cuts. The cash rate more than halved from 7.25% to 3% in just 8 months from September 2008 to April 2009, and the Rudd government's first home buyer boost during the global financial crisis. But it was fleeting. The government grants were temporary, and then RBA Governor Glenn Stevens stuck with his predecessor's playbook and started hiking rates again in October 2009 as it became clear the worst of the GFC, or the global crisis, had passed. However, as the mining boom turned to bust and desperate for another source of economic growth, the Reserve Bank itself turned to residential construction as saviour. With no major changes in government housing policy, it's abundantly clear that the property price boom that ran from 2012 to 17 was largely down to the RBA's cuts from 4.75 down to 1.5%. And what we're seeing here is an artificial suppression of the cost of money. Okay, the cash. This is a manipulation of the interest rate for cash, and so naturally you're getting, and I'm not bringing up this. I mean, you can see here, we can see just the foreign investment as well that came in. Look at how that spiked between 12 and 17. Look at it on this chart, guys. So yes. So capital city property prices since September 05. Melbourne, look at Melbourne. Sydney, Hobart. Hobart's shot up as well, guys. Hobart's just been crazy. I think I'll capture this chart for future videos. Hobart, where's Brisbane? Yeah, we've not grown as much. I mean, yeah, Hobart, that's not surprising. Well, it's a little bit surprising. It's getting less affordable to live down there now. So it wasn't as big as the early 2000 booms, nor, Mr. McFarlane said, was it so exclusively dominated by speculative investment purchases. But he added it definitely did seem bubble-like. One of the reasons it wasn't as dominated by speculative investors was intervention by the regulators. The banking supervisor APRA, in consultation with the Council of Financial Regulators, which includes the RBA, started putting the brakes on investor lending in late 2014, probably trying to avoid a repeat of the early 2000 craziness. Nonetheless, housing prices across Australian capitals jumped by 2/3, dominated by increases in Sydney and Melbourne. That prompted APRA to limit other forms of risky loans, such as interest-only mortgages, while ASIC and the Banking Royal Commission focused further scrutiny on lax lending standards. By the end of 2017, the boom ran out of finance and out of momentum. Prices fell around 15% in Sydney and 11% in Melbourne, but were still more than 80% higher than when Mr. McFarlane left the RBA. Once again, it was the Reserve Bank's rate cuts, this time in conjunction with APRA loosening its lending restrictions and the re-election of a coalition government promising the continuation of investor tax breaks that turned home prices back upwards. While this might spell relief for property owners, developers, banks and real estate agents, Mr. McFarlane isn't sure it's a good thing for the economy long term. It probably would have been better to have had a bigger correction, although over the short term that would have hurt a bit. Or maybe he should have let a correction happen when he was there, when he was in charge of the Reserve Bank. It's easy with hindsight, isn't it? I'd argue we need to look at ways to encourage the investment for people in Australia to move out of housing into other sectors. We need to, I would say, rather, any attempt to reduce negative gearing or capital gains tax discounts, that's going to cause political problems because so many people are invested in that and they're using that for their retirement. So you need to create methods where people can get a greater financial incentive to invest in other mechanisms that can have a greater benefit on the wider economy. Maybe lending to small businesses, other schemes. We need to think of ideas, and it's going to be challenging because housing is so ingrained in Australian culture and the way people use to build wealth. Let me know if you have any ideas, guys. Any other suggestions, please leave them in the comments. So where to now? Having now seemingly twice avoided property crashes after bubbles, does the former Reserve Bank head think we will be third time unlucky for Australia. Do I see the risk of a collapse in house prices? No, I don't, he told the Jolly Swagman podcast. I think that those huge long-term structural factors are so powerful, the desire for people to compete with each other to buy houses or apartments in places where there are good jobs, which means big cities, people coming from other parts of the world to do it, people coming from the country to do it, people already here are doing it. I think a fundamental shift in the relative price of housing has occurred over the last 30 to 40 years. I don't think it's ever going to go back to where it was. But does that mean anyone who can should rush out to buy investment properties? Mr. McFarlane thinks not. I don't think it can continue to go up as fast as it has over that period, he forecast. I think we've reached the limit of the housing sector's capability to service mortgages. And in some ways that's concerning too, because so much of our wealth is invested in this. After leaving the Reserve Bank's top job, Mr. McFarlane crunched the numbers and believes most property investors would have been better off putting their money elsewhere. If you're lucky enough to buy right at the bottom and sell at the top, yes, you will make money. But that's only a minority of people who do that, he said. The majority, I think, either make not much more money than they would in the bank, and in many cases, they lose money. Well, I mean, he's got a point there if you factor in all the cost of maintenance and just all the other overheads. For the few who do succeed at making money out of rising property prices, he had this message. You're making yourself richer at the expense of your children. And like the use of non-renewable resources or the pollution of a finite earth, that kind of intergenerational theft clearly isn't sustainable. Well, there you go. There you go, guys. What do you think about this take? Do you think our property prices will keep going up, or do you think they will stagnate? Do you think we'll just, they'll flatline? They will flatline. With cash rates so low, and people are not forced into arrears, if people are not forced to sell, people will generally do what they can to hold on their properties. And I think it's in the bank's interests to work with their clients to try and keep as many of them in their houses as they can, because they don't want the value of their assets, which are our mortgages, to decrease. So could it just flatline for the next 20 or 30 years? Or do you think we'll hit a crash? What will there be? Maybe. I would argue more that we'll see it flatlining than it continuing to shoot up. I can't see what would be driving it up. Sure, supply with building approvals is going to drop, but there's a lot of stock on the market. We might see a correction again. We'll have to wait and see. Do you think it will crash? Will it be a snowball? Will a whole lot of people just fall over and not be able to service? What do you think could happen there? Anyway, guys, I'll leave it up to you to let me know your opinions in the comments below. Thank you for watching. If you're a fan of the channel and want to help support us, we have a Patreon where you can make a small monthly donation. You can also join the channel here on YouTube as a member, where you get access to badges and emojis that you can use. We have affiliate links with Independent Reserve for your crypto trading, Amazon and eBay for your consumer purchases, and we also have merchandise on the HeiseSays website and PayPal if you'd like to make a donation that way. Thank you all very much for watching. Have a great day, and I will see you all tomorrow. Bye for now.